Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. We're in a long, prolonged series of helping you evaluate the different alternative solutions for planning for if you or a loved one might need to go into a nursing home or require advanced skilled care at home. It's devastating to a family's finances if this happens, but it's even worse if it happens to a family with no planning. The family is frantically trying to figure out how can they take care of mom or dad or a loved one or a spouse and yet not be wiped out financially or wipe out the other spouse financially for caring for the one who is institutionalized or needs the care at home. So what I decided to do, I'm doing this long series of these workshops and the radio shows just to try to help communicate all the different resources and strategies that are available to help you pre-plan for these problems. Some of the strategies are even available after the problem exists, so at the time of need. The rest of them, we like to plan in advance because it's a less expensive way. So what I was doing was last week, I started sharing with every one of you this survey to try to illustrate that came out on long-term care, the need for long-term care, how much long-term care is costing, how much insurance policies cost, how to shop for them, what features to look for, to try to help many of you see what's the norm, what's the average, what do most people buy, what are the costs, and what type of options are available if you're shopping for long-term care insurance. So that article I mentioned last week in that survey came from Broker World magazine. So I'm going to do this as a continuation of that survey and point out some other factors that I think are valuable for you to evaluate in your own situation and circumstances. Now, to buy long-term care insurance, which I'm going through in this section of the series, is only one of the many different types of solutions and strategies for pre-planning for this, again, I say most devastating need in the area of retirement. But there are other solutions I'll get into, I did in past shows, and I will in future shows, that have nothing to do with insurance, so that you know if you're healthy and eligible for insurance, that's one thing, but what if you're not? Well, those of you who still want to try to prepare and plan, there's hope, because I will get into non-insurance related solutions over upcoming shows. But for now, let's continue on this survey that I was going through to share with you, really illustrating numbers to try to show you how big is this problem? How serious do you have to be at planning for this? What we looked at last week, the costs for nursing homes and care at home is going up exponentially. So we're looking at a rate of inflation of 9 to 11% increases in nursing homes, and we're looking at a rate of return on savings accounts in the banks at less than 1%. So we have a little bit of a problem on, are we keeping up with the ability to handle care in the future when it's accelerating at that high pace? So let me continue with a survey, and it'll help shed some light on some of these issues. The first thing is, how many of us need long-term care planning? The survey can help shed some light on that, because it goes to say, when we look at whether we need a nursing home or not, or whether we'll need that type of care, these companies can put out all the averages they want, in my opinion. and none of them matter. So when you're asking the question to yourself, what are the odds that I will have to go into a nursing home? My spouse will have to go into a nursing home. What is the average length of stay? What can we expect? There are two different questions. When I say what's the average length of stay in a nursing home, they might answer me 2.3 years or 2.4 years. But if I say, how long's grandma been in a nursing home? They might say she's been in 10 years and still going. What good are those averages if I would have used those averages for grandma? They would have been useless. So what I want to point out to everyone listening and watching, each one of you and myself are an individual. We are one person. If you put 100 of us in a room and you take an average, that average won't be true for any one of us in that room. It will be true for all of us as an average, but for any one of us, one might be in the nursing home for 10 years, one might never go into a nursing home, one might be in a nursing home for a week. Well, now what do? I'm trying to keep families from being wiped out if you or a loved one need to go into a nursing home. So I'm telling you, you need to plan for if you need to go into a nursing home, would that wipe your family's finances out? Or would that have a devastating impact on other family members who are dependent on those assets and that income that now a nursing home might be getting? Very critical. So you need to plan based on you individually. If your health is good, you might be at a higher risk of a family devastation due to a nursing home stay. People ask, why would I be at a higher risk? And I'm not saying you would be at a higher risk. I'm saying you might be at a higher risk. You want to know why? Someone with very poor physical health, if they go into a nursing home, versus someone with excellent physical health, if they develop Alzheimer's or dementia and go into a nursing home, the one that's healthy might live far, far longer in the nursing home. And the one with poorer health might be a much shorter stay, which is less financially devastating to the spouse at home or the family at home. So while we fight to stay and get healthy so we can live real long, once we go into a nursing home, we might be punished for that good health financially for those we leave behind, because the longer we're there, the more assets we're draining. You see the opposite effect that good physical health might have on our finances. Wow. So how do you plan for this stuff? You take yourself individually and you say, if that bad thing, that risk I'm hoping doesn't happen, does happen to me, if my number's up, it's my term, it's my turn on the wheel, what can I do to protect my family and loved ones? That's the right question. That depends on how much assets you have, what your health is like, matters but doesn't matter. Sometimes it matters, sometimes it doesn't. Someone says, I'm in great health, or my spouse is in great health, they're going to live to 90 or 95. You can't trust that. They could have been hit by a car yesterday and your plans wouldn't have worked. It's not only based on health. So what you need to do, in my opinion, is evaluate, do we have a risk if either of us go into a nursing home? Do we want to prepare or solve for that risk? And to what extent? And the answer usually revolves more around, how much do we have to lose if it happens to us? How do we need to plan to make sure not to lose our life savings that we worked so hard to accumulate? Some people might have $300,000. Some people might have $3 million. Some people might have $30 million. Folks, the planning is different for all of us. So that's what I wanted to share. But guess what? I had 1 month when you say, okay, we're interested in long-term care insurance. I had 1 month about 4 or 5 years ago we had 6 or 7 applications, well, 5 families, but it ended up being 10 applications for long-term care insurance with different insurance companies. We applied for coverage. Maybe they were in their 70s. Maybe they were in their 60s. I can't remember because it was long enough ago. Every single application we worked so hard to complete and send in to the insurance companies, every single one of those was declined. By their medical questions, they didn't look that bad to me. So, I have a statistic here from this article that shares the survey results that says only 65.8% of the applications were placed in 2013. In other words, almost 40% of the applications that were submitted couldn't get placed. Now, that either means they couldn't qualify medically, or the policies were then proposed and they didn't accept them, so the coverage wasn't placed. But it says that's the way that the numbers, the average numbers, are working. So what I implore most of you who are healthy, whether you want this coverage or not, you need to begin evaluating, can we qualify, is one major question. There's no sense racking your brains out over, can we afford it, if you would apply and couldn't qualify anyway. So one first test might be, if you're on the fence, get applications in and get the companies evaluating whether they want to write you while you're evaluating while you want to take them, because it factors into the decision. Now, here are some more statistics from this survey. This survey was based on 2013 because 2014 isn't out yet. But 2013, it says, although no carriers, and I went over this last week, a lot of carriers have dropped out of the long-term care insurance market. But it says, although no carriers that they surveyed dropped out of the market in 2013, so they went out to about 16 insurers, they said, currently sell standalone long-term care insurance policies in the United States. It says the market is far from stable, which gets to my next point. When you choose who to shop for long-term care insurance coverage, you're choosing a partner in the company and the quality of the company, and whether your best guess is that they will stay in the industry, this industry of long-term care. So they might continue life insurance, but maybe exit the long-term care insurance segment. So you want to try to choose companies that have a high presence in the long-term care portion of the segment of the industry. But this goes on to say some major carriers currently are expressing serious concern, it says, about their ability to provide traditional long-term care insurance and make reasonable profits with reasonable certainty. You know, folks, if they can't, they're not going to be in the market. So you don't want the cheapest rate if it means it's a company that isn't charging adequate enough rates to sustain their ability to make a profit and stay in the market. So use some common sense here. It also says in this survey something we also know. Existing policyholders continue to see large rate increases. Ouch. We don't like rate increases. You don't like rate increases. The companies don't like rate increases because that's an admission that they miscalculated rates. However, it goes on to say insurers seem likely to experience favorable deviations in the future. Favorable deviations in the future mean possibly less increases. And it says relative to today's pricing assumptions because interest rates are likely to rebound. Do you remember last week I mentioned part of the component of the rate, the premium rate charged, is how much the insurance company has to pay on claims, what age group they have to insure, and what interest they can earn, what earnings they can have on the premiums until they have to pay them out in claims. So the younger the workforce is that's purchasing insurance, the longer the company has their money, earnings, and earnings on their money before they need to use them for the time of claim. So the younger workforce buying these helps the insurance industry. All right, now, claims. Total claim payments rose for 2013, which is expected, but they rose 11% more than in 2012. The total in-force premium, though, rose only 5%. So that's, again, they say, demonstrating the tip of the iceberg nature of long-term care insurance claims. And they also say claims rise year over year because, like I say, the younger policyholders are getting older. But the claims are lasting longer because people are living longer, which is again raising now the cost per person of the claim. So the insurance companies say if one person needs to go into a nursing home, maybe they would have paid out 3 years and calculated the benefit that they would have paid out $3,000 over 3 years. That would have been $109,000. And then the companies say, but if that person is younger and living longer once they go on claim, the claim's going to be bigger. It might be $3,000 a month, but the people are living longer, the claims might be bigger, which gets me into my next point. When you have a claim, does the company pay for however long your claim lasts? No, unless you have unlimited benefit, but most policies have a cap on the maximum benefit they will pay out. The cap can be either dollars, number of months, amount of days, but there is a cap usually. You can buy policies that have an unlimited benefit with no cap on the number of years, but they still have a cap on the amount of dollars per month or per day. So you'll see that listed as a daily benefit maximum, monthly benefit maximum, lifetime unlimited still probably has a daily maximum payout. So if you have a policy that says $100 a day maximum for lifetime, really what you have, $100 a day, roughly averages $3,000 a month, roughly averages $36,000 a year. If the person's in the nursing home still 10 years later, they're still paying and have already paid $36,000 a year times 10 years and still going, they're already out $360,000. That same person who does not have unlimited benefits goes into the nursing home, is in there for 10 years, but bought a 3-year benefit for $100 a day. That means that person's policy from day one paid the same $100 maximum daily benefit, which is $3,000 a month or $36,000 a year. That same person was in the nursing home for 10 years, but had purchased only a 3-year maximum payout. So that means that person received $36,000 for the first 3 years and they were out of coverage. So when you're shopping for coverage, you will want to pay attention to the daily maximum and the number of years. Now, I got into this in a couple other shows. You could buy a monthly maximum instead of a daily maximum. And that, again, means especially important at home care versus in a nursing home. But that means if you're getting care for $300 a day at home, but the home health aide only comes 2 days a week, that you've only used up $600 of your benefit, but you got the whole benefit if you're on a monthly maximum. If you're on a $100 daily maximum, they came out 2 days, you have up to $3,000 a month, but no more than $100 of that can be used in any day because you have a daily maximum. That means you only receive 2 visits, $100 paid toward each $300 visit. At the end of the week, you only collected $200 for your $600 worth of care, where the person who bought the monthly maximum limit got the whole $600 for the $600 care for those 2 days for the week. If you have 4 weeks of coverage like that, obviously you have $600 each week. Times 4, you have $2,400 of actual expenses. But on the $100 a day plan, if you only had care for 2 days, you only got $200 a week times 4 weeks. So you have $800 from the insurance company. The monthly maximum policyholder gets $2,400. So do you see how long it will take for a daily maximum to be used up if there are only intermittent days of care capped by a daily maximum? You see how complicated this is to try to shop for insurance on your own? Do not try this at home, folks. Follow my advice I give on every show. Call us. We will help guide you through the process of shopping for long-term care insurance. We know what to look for. We know what to ask. We know the different provisions. We know the different insurance companies that are high quality in this field, that are of higher preference to shop versus lesser, who might look like an attractive lower premium and in fact maybe not be as favorable an option for you as others. So let us do the work for you, and feel free to give us a call rather than trying to navigate this most complex area yourself. When I come back next week, I will share more of the information for those of you who have other family members or friends. Please ask them to tune in or get on our email list so they can get copies of this show too, get enlightened on many of the areas of financial planning that there is help available, and to know what questions to ask in advance makes it a little easier. Thanks again for tuning in this week. We'll be back again next week on All Things Financial.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through Sage Point Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with Sage Point Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.